You are coming out making sort of a stand on active versus passive investing and what this environment demands right now. Explain.
That's right, Sarah. So I think coming out of 2008, we had good expectations for future returns. 7.5% is what we expected back then over a 10-year window. This is a very different cycle. We've moved through the market cycle very, very quickly. We're starting with very expensive equity and bond market valuations. So we project only 4.3% expected returns over the next decade. To us, that says last cycle was the cycle of beta. This cycle is the cycle of alpha. Passive alone is not going to cut it. We need to be able to take advantage of some of the valuation dispersions beneath the surface to add to those returns and get us closer to a 6-7% return, which is what investors actually needed.
Gabriela, should people also be trying to be a bit more active about their geographic exposure at the moment as well?
Absolutely. Part of the valuation differences we see are not just within the U.S. equity market, but also between regions. So we still have about a 20-year discount between international markets and the U.S. market. And this is even compared to normal discounts that we have for these less quality markets. So I do think a big component is exactly overweighting other regions. That'll include Europe, that'll include Japan, as well as new asset markets like China, which we are also taking a stand on and saying that it's going to be a very big growth piece of portfolios over the next decade, both on the equity and the bond side, because they can add a lot to risk-adjusted returns.
Why now for China?
Well, first, you have a much better entry point in terms of valuations than you did back in February because of the 30% plus correction that we've had this year. And because beneath all the headlines we've had this year, China continues to develop and open up its capital markets. And you have some really interesting themes there related to the new China around technological innovation, the growth of China's middle class, which is only halfway through, as well as China's decarbonization efforts. So better valuations, developing capital markets, and very strong growth themes.